Welcome back to Actionable Reads. Ready to dive back into The Intelligent Investor.
Absolutely. We're picking up with chapters 8 through 14 this time.
Last time, we really dug into what it means to be an intelligent investor, right? All those core ideas.
Yeah, the groundwork. But now we're going to see how those actually play out, in the real world of investing.
This Mr. Market thing, everyone talks about it. I'm curious how that's going to come into play.
It's key. Chapter 8, the investor and market fluctuations. That's where Graham introduces him.
Oh, right.
Mr. Market. Think of him as this kind of whimsical character, always wants to buy or sell your stocks.
Okay. But there's a catch, I bet.
Big one, his offers. Totally driven by his mood. Changes every day, wildly.
So not exactly a reliable dude.
Nope. And the thing is, it's got nothing to do with the actual value of the businesses you own.
So how do we as investors handle that emotional roller coaster? That's got to be where people get tripped up with fear of missing out or panic selling.
You got it. Think about it. You see a stock you're watching, suddenly it shoots up. Do you feel that pull? Gotta jump in and end a W.
Oh, 100%. Or the opposite, right? Market takes a dive and suddenly you're like, sell everything.
Exactly. Mr. Market, he feeds on that, our human emotions. But Graham's saying, all that short-term stuff, it's just noise.
The intelligent investor, they're looking deeper, right?
Right.
At what the business is actually worth.
Yep. Earnings, assets, the management team, the things that actually matter long-term.
So tuning out Mr. Market's little tantrums, that's step one.
You got it. And this leads to something kind of counterintuitive. Risk actually goes UP as prices go up.
Wait, really? Explain that one.
When a stock is crazy high, it's usually hype, speculation, not solid value. That's when it's most likely to crash, even if it feels exciting.
So the risk isn't the volatility itself, it's overpaying.
Exactly. No matter how hot something seems, and this is where we get to, index funds. Didn't exist in Graham's time, but his ideas point right at him.
Interesting, because he was all about diversification, right?
Big time. And index funds, they're like buying the whole market, not trying to pick individual winners.
So you're sidestepping Mr. Market's drama, betting on the economy as a whole.
Exactly. He didn't use the term index fund, of course, but the principles. Perfect match. Diversification, low costs, long-term view.
I've definitely chased hot tips before, thinking I was going to miss out.
Yeah.
Usually ends with me buying high and selling low.
We've all been there. That's why Graham's approach is so good. Focus on the fundamentals, tune out the noise, be patient.
There's another term that caught my eye. Asset elephantiasis. Sounds like a disease.
Right. It's Graham's way of saying when a fund gets too big, it gets hard to perform well. Imagine an elephant in a tiny room. Can't move well, right? Same for a giant fund trying to find good investments.
So even if a fund has a great track record, its size can work against it.
Exactly. That's why thinking for yourself is so important. Don't just follow the crowd. Look for well-managed funds, reasonable fees, and watch out for those that have gotten too big.
Makes sense. Now, Chapter 10, that's about advisors, right?
Yep. Investors and their advisors. We all wish someone would just tell us what to buy sometime.
Oh, yeah. But Graham warns us about putting too much trust in anyone.
He's not saying all advisors are bad. It's about the right relationship.
So it shouldn't be about getting stock picks handed to you.
Nope. It's about developing your own investment philosophy. What are your goals, your risk tolerance, your time frame?
So self-awareness is key, even before picking stocks.
Big time. A good advisor helps you figure that out, not just throws names at you.
Any red flags we should watch out for when picking an advisor?
Definitely. Anyone who pressures you, uses scare tactics, or only cares about short-term gains, bad sign. If your gut says something's off, it probably is.
It's our money after all.
You got it. And Graham specifically says, find an advisor who invests a lot themselves.
Why is that?
Skin the game. You want someone who's putting their money where their mouth is. Someone who truly understands the market, not just the theory.
So shared experience matters.
Big time. Someone who's been through the ups and downs firsthand. That builds trust.
All right, so chapters 11 and 12. Now we're getting into the real nitty-gritty security analysis. This is where I started to feel intimidated.
I get it. It can seem like a ton of financial jargon.
Right. But Graham makes it approachable.
That's his genius. You don't need to be a Wall Street whiz to understand this stuff.
So we can actually learn to do this ourselves.
Absolutely. Graham focuses on a few key ratios, like the current ratio. That tells you if a company can pay its short-term debts.
Okay, I think I remember that from accounting class.
Imagine a company has a current ratio of 2. For every dollar they owe, they've got $2 ready to go. That's good.
It's so higher is generally better, right?
Usually, yeah. It means they're less likely to run out of cash anytime soon. Then there's the debt-to-equity ratio.
How much debt they're using compared to how much the owners put in.
Exactly. Like a ratio of 1 means they've got equal parts debt and equity.
But companies can play games with those numbers, right? Make themselves look good.
Yeah, Graham knew that. He warned about non-recurring costs that somehow keep recurring.
Sneaky.
And other accounting tricks. You got to look beyond the surface, read the footnotes, ask critical questions.
Don't just trust the pretty picture they're painting.
Right. Look for trends over time, consistent earnings, transparent reporting. That's how you spot the real deal.
Graham's cash is king principle. I love that one.
It's so simple but true. Would you invest in a company constantly bleeding cash?
Probably not a good idea.
Nope. Healthy businesses make more cash than they spend, and they can use that to grow, pay dividends, reduce debt.
It's like checking the company's pulse. If it's weak, watch out.
Exactly. And that's the heart of value investing. It's not about flashy names. It's about finding solid companies, well-managed, making real cash.
Now, chapters 13 and 14. Graham shifts gears a bit here. Starts talking about picking stocks for a defensive portfolio.
Right. He introduces the concept of a defensive investor. He even uses this great analogy, check 6.
Oh, from his Air Force days, right?
Yep. Just like a pilot constantly scanning for threats, even when things seem calm, a good investor's always looking for weaknesses.
Yeah. So it's not just about looking for the good stuff. It's also about spotting potential risks, even in seemingly great companies.
Exactly. And that's where all these ratios and analysis come in. You're comparing companies, looking for those hidden discrepancies.
Like those spot the difference games.
Yeah.
Got to pay attention to the details.
You got it. Those details can make or break your returns. He walks us through a comparison of 4 companies: Eltra, Emerson Electric, Emery Air Freight, and Emhart. On the surface, they all sound kind of similar, right? Like on manufacturing or industrial services or something.
Right. But we got to dig deeper, like you said.
Exactly. One might have tons of debt, another's profits are shrinking. You got to look under the hood.
It's amazing how different companies can be, even in the same industry.
Yeah. And those ratios we keep talking about, that's where they shine. Comparing price to earnings, debt to equity, you start to see which ones are the real deals.
It's not enough to just say, oh, that's a good company.
Nope. Got to find a good company at a good price. Even a fantastic business can be a lousy investment if you overpay.
Speaking of overpaying, Graham wasn't a fan of those super high-growth, high PE stocks, was he?
Not really. He saw those and thought of the late 1920s, all that speculation. Companies valued on potential, not actual earnings.
Kind of like the dot-com bubble, right?
Exactly. People chasing the next big thing, but not looking at the fundamentals.
It seems like that happens over and over again in history.
It does, yeah. People get caught up in the excitement. That's why having Graham's principles to guide you is so important.
So how do we avoid falling into that trap? It's so easy to get swept up in the hype.
It goes back to what we've been saying. Discipline, patience, focus on the intrinsic value. Don't just buy into the hype. Do your own research. And remember, sometimes the smartest move is to do nothing. If you can't find anything that fits your criteria, it's okay to wait.
That can be tough, though. It feels like you're missing out when everyone else is making money.
I know, but that's where having a strong investment philosophy helps. If you're grounded in those principles, you're less likely to make impulsive decisions.
It's like having a solid foundation to keep you from getting swept away when the market gets crazy.
That's a great way to put it. And that's what Graham provides. A framework to help you navigate the market. It's not about getting rich quick. It's about building wealth over time in a sensible way.
Now, in these chapters, Graham starts getting into specific advice for building a defensive portfolio, right?
Exactly. The defensive investor is someone who prioritizes safety and stability. They're looking for those sleep well at night investments.
I think a lot of our listeners fall into that category. They want to grow their wealth, but they also want to avoid those big, scary losses. So what does a defensive portfolio look like, according to Graham?
Well, he suggests focusing on large, well-established companies with a history of profitability and a strong financial position.
Kind of like the blue chip stocks, the ones that have been around forever and weathered all kinds of storms.
Exactly. It's a slow and steady wins the race approach. You're not trying to hit home runs. You're just trying to get on base consistently.
And diversification is key too, right? Don't put all your eggs in one basket.
Absolutely. Graham recommends holding at least 10 different stocks, but no more than 30. That helps spread out your risk.
But picking individual stocks can feel overwhelming, even with diversification.
And that's why Graham's thoughts on index funds are so relevant. He said that for the defensive investor, a low-cost index fund can be a great core holding. You're basically buying a tiny piece of the entire market.
It's like taking the pressure off of having to pick individual winners and losers.
Exactly. You're letting the market do the work for you. And over the long term, that can be a very powerful strategy.
In Chapter 14, Graham talks about protection versus projection. What did he mean by that?
He's warning about the danger of trying to predict the future. It's tempting to buy a stock because you think it's going to go up.
Oh yeah, we all want to find that hidden gem that's going to make us rich.
But Graham says that's speculation, not investing. It's much more important to protect yourself from paying too much for a stock.
So focus on what you know right now about the company, not what you hope will happen later.
Exactly. It's about that margin of safety we talked about before. You're buying a stock for less than it's really worth, so even if things don't go perfectly, you're protected.
It's like having a buffer, just in case.
Right. That's what intelligent investing is all about. It's not about taking big risks or trying to outsmart everyone else. It's about making smart decisions, protecting your capital, and letting time and compounding do their thing.
So if we were to boil down these chapters into a few key takeaways for our listeners, what would they be?
First, don't underestimate the power of index funds. It's a simple, low-cost way to build a diversified portfolio that can perform well over time.
Second, remember protection over projection. Don't get caught up trying to predict the future. Buy stocks when they're undervalued and have that margin of safety.
And third, always keep learning. You don't need to be a financial expert to be an intelligent investor, but you do need to be willing to put in the effort to understand the basics.
That's great advice. And in the final part of this deep dive, I'm really looking forward to exploring some specific examples of how to put these principles into practice. We've covered a lot of theory. Now it's time to get down to the nitty-gritty of real-world investing.
Remember those 4 companies we were looking at before? Eltra, Emerson Electric,
Emery Air Freight and M. Hart, right?
Yep, those are the ones. Seem pretty similar on the surface, all doing some kind of manufacturing or industrial stuff.
But we know better than to just stop at the surface now, don't we?
Exactly. One could be drowning in debt, another's profits might be tanking. You got to really get in there and poke around.
It's amazing how different companies can be, even when they seem to be in the same business.
Oh, absolutely. And that's where all those ratios and financial analysis come in. You got to compare them, see where the hidden problems are.
It's like being a detective. Except instead of looking for clues, we're looking for, I don't know, financial red flags.
Something like that. And those red flags can cost you a lot of money if you're not careful.
So it's not enough to just find a company you like. You got to make sure the numbers make sense too.
You got it. Even the best company in the world can be a bad investment if you pay too much for it.
That reminds me of something else Graham talked about, those high-growth, high-PE stocks. He wasn't a big fan of those, was he?
Not really. He saw those and thought back to the 1920s, all that crazy speculation. People buying companies based on what they might do someday, not what they were actually doing.
Kind of like the dot-com bubble, right?
Yeah.
All those internet companies with sky-high valuations, but no profits to show for it.
Exactly. People getting caught up in the hype, forgetting to look at the fundamentals.
It seems like history just keeps repeating itself, doesn't it?
It does, yeah. People get greedy, they get scared, and they make bad decisions. That's why having a solid framework like Graham's is so important.
So how do we avoid making those same mistakes? It's so tempting to get caught up in the excitement when everyone's talking about the next big thing.
Discipline, patience, and remembering what really matters. Intrinsic value. Don't chase hype, do your research, and if nothing looks good, don't be afraid to wait.
That's easier said than done, though. It's hard to sit on the sidelines when everyone else is making money.
It is tough, but that's where having a strong investment philosophy comes in. When you have a clear set of principles to guide you, you're less likely to get swayed by the market's ups and downs.
It's like having a roadmap to keep you on track, even when the road gets bumpy.
Exactly. And that's what Graham gives us in The Intelligent Investor. A roadmap to navigate the market and build wealth over time.
So as we wrap up this deep dive, what's the most important thing you want our listeners to take away?
Think for yourself. Don't just blindly follow someone else's advice. Take the time to learn, develop your own philosophy, and always remember, successful investing is about making rational decisions, not emotional ones.
Couldn't have said it better myself. The Intelligent Investor is a book you can come back to again and again as you learn and grow, and there are so many other great resources out there too.
Websites like Morningstar, Value Line, those are great places to find in-depth information and analysis on companies.
So there you have it. our deep dive into the intelligent investor is complete. We hope you learned a lot and feel empowered to take control of your financial future. Thanks for joining us. Until next time, happy investing.